His fund has made more money than any hedge fund in the history of the world, over $90 billion in profit. More than Soros, more than Dalio, more than anyone who has ever played the game.
There's no comparable compounding story in the history of money, and it was built inside the most competitive arena on Earth, where every rival is trying to take it from you daily.
Every time something died on Wall Street, Enron, Amaranth, Lehman, Melvin, Ken Griffin ended up richer.
At some point, people stopped calling that luck. That's when the conspiracy theories started.
He has been called the most powerful man in American finance. He has been called the most hated man on the internet. He has never been called wrong for long. His name is Ken Griffin, and this is the story of the Citadel. Boca Raton, Florida, a town where middle-class comfort and serious money live on the same streets. Ken Griffin's father is an engineer. The family is not rich, they are adjacent to rich. And for a certain kind of boy, that distance becomes an engine. Griffin is president of the math club. While classmates flip burgers, he runs a mail-order software business out of his bedroom, inventory, margins, customers who never see his face. He is 17 years old.
To be a computer nerd has obviously turned out to be a pretty good place to be in life. And yes, I was very interested in both mathematics and programming in high school. And it's defined my career and it has had a very important role in my life.
In 1986, a freshman at Harvard, he reads a Forbes article trashing the home shopping network. Griffin decides the stock is overpriced and bets against it with put options. The bet pays. But the profit isn't what he remembers. What he remembers is the broker's fee.
Most kids celebrate their first winning trade. Griffin got angry about the middleman's cut. 20 years later, he built Citadel Securities, the machine that replaces the middleman, over that exact same irritation.
Furious at the fees, Griffin walks into the Harvard Business School library and teaches himself finance theory. Then he builds his own pricing model for an obscure instrument most of Wall Street can't be bothered to understand: the convertible bond.
A convertible bond is a corporate loan with a stock option welded on. Pricing it right means valuing both halves at once. And in the 80s, the big institutions holding them mostly didn't bother. The market was selling dollar bills for 90 cents to anyone with the math to notice.
Griffin has the math. What he needs now is money. And the money is about to walk through the door of a Palm Beach bank. Summer 1987. Home from college, Griffin visits a broker friend at the First National Bank of Palm Beach and starts explaining his bond model. A retiree named Saul Golkin wanders in. He listens for 20 minutes. On his way out the door, he commits his money. Family and friends fill the rest, including Griffin's grandmother, who puts her savings into her grandson's hands. Total, $265,000. Griffin is 19 years old.
Managing his grandmother's money made the whole thing more visceral. Every risk system Citadel builds for the next 40 years exists to keep that one promise. Grandma's money does not go to zero.
Back at Harvard, there's a problem. He needs live market data, and the university bans students from running businesses on campus. So Griffin lobbies. He argues the fund, a Florida partnership, is technically an off-campus activity. The administration folds. A satellite dish appears, hanging out a third-floor window of Cabot House, pulling stock quotes down from the sky.
That dish told you everything about the next 40 years. Where other people saw rules, Griffin saw negotiable obstacles. He didn't break Harvard's rule. He reclassified reality until the rule no longer applied. Regulators would be dealing with that exact mind for decades.
The dish goes up in the fall of 1987. The timing is almost supernatural, because the worst single day in stock market history is now weeks away. October 19th, 1987. Black Monday. The Dow collapses 22.6% in a single session, the worst one-day crash in history.
As the Dow Jones Industrials took off on a fear-fed freefall to close down a record 508 8.32 points. Panicked traders worked through lunch hours in a desperate but losing attempt to keep up with tickers that rolled up an all-time high volume.
Fortunes built over decades vanish before dinner. In a dorm room in Cambridge, a 19-year-old watches the numbers fall with $265,000 of other people's money on the line, his grandmother's savings included. But Ken Griffin is not losing. He entered the storm holding short positions, bets that pay when markets fall. While grown men weep on the floor of the New York Stock Exchange, the teenager profits.
This is the most important day of his life, and nothing about it is normal. His first real market experience is a catastrophe that pays him. He learns at 19 that panic is a transfer of wealth from the unprepared to the prepared. Every fortune he makes afterwards is that same lesson at a bigger scale.
By graduation in 1989, an economics degree finished in 3 years, Griffin runs 2 funds and manages roughly $1 million. The track record is real, audited, repeatable.
Producing 2 years of consistent returns while carrying a full Harvard course load that told serious money this wasn't luck. Repeatability is the only thing allocators actually pay for.
And one man is paying very close attention. A Chicago fund pioneer named Frank Meyer, who is about to make the bet of his career on a 21-year-old. Chicago, 1989. Frank Meyer, co-founder of Glenwood Capital, does something no serious institution does. He hands a 21-year-old $1 million of the firm's capital and tells him to trade. Griffin returns 70% in his first year. Meyer later admits, if you told him he would stake his reputation on a 22-year-old, he'd have said never. Then he met Ken Griffin. Note what Griffin turns down. With those numbers, Goldman Sachs and the great New York houses are open to him. He chooses Chicago because in New York, he'd be an employee inside someone else's machine. In Chicago, he owns the machine.
Meyer gave him something worth more than the million: the architecture. Don't build a one strategy fund. One edge dies with one market. Build a platform of many strategies that don't move together. And here's what's remarkable. A 22-year-old accepting his own winning trade had an expiration date. Almost nobody does that.
November 1990. With $4.6 million, most of it Meyer's, Griffin launches his own firm. 5 people. 3,000 square feet in Chicago's Loop. He is 22 years old. The first full year returns 43%. The second, 40. The boy wonder does not lose.
43 and 40% in a 5-man shop, trading an instrument that most bigger players ignore. This is what real edge looks like. Not a hot streak, but a structural mispricing plus better math harvested systematically. The only real question was how big he could scale before the inefficiency closed.
But the winning streak carries a hidden poison, because Griffin now believes he cannot lose. In 1994, the market is going to correct that belief and nearly take the firm with it. Inside the firm, Griffin is building something Wall Street doesn't respect yet. While the era's kings, Soros, the macro gunslingers, trade on gut and geopolitics, Griffin hires a former Soviet rocket engineer to build models. He is betting the future belongs to the machine, not the gut. Then, 1994. The Federal Reserve hikes rates. Bonds and stocks fall together. For the first time in his life, Ken Griffin loses money, down 4%. 4% sounds like nothing. It is everything. Investors flee. A 25-year-old flies to Geneva and Zurich, begging skeptical private bankers for capital. Some say no. He flies to the next one.
Access to capital has never been as straightforward as it is today.
Here's a lesson that separates Griffin from every manager who blew up later. He didn't blame the market or fix his pitch. He studied the real problem. The problem wasn't 4%. It was that clients could put capital at the worst moment, forcing him to sell good positions at bad prices.
Griffin extracts a conclusion that will define the next 30 years. The enemy is not losing money. The enemy is other people's right to panic. That same year, he renames the firm. Wellington becomes Citadel, the fortress inside the fortress. The structure designed for one purpose, to survive when the city around it burns. He spends the next 4 years re-engineering the one thing no one else thinks to fix, the contract. And his timing is about to look supernatural. Again.
So much of Citadel's success comes down to one thing: access to sophisticated financial markets and the ability to move capital efficiently. Now, obviously, none of us are running a multi-billion-dollar hedge fund, but Trench.io is making leverage trading far more accessible for individual traders. If you think a stock like Nvidia still has room to run, Trench.io lets you capture more upside with payout multipliers of up to 1,000 times across stocks, crypto, and more, all from one clean dashboard. With this, your $100 deposit turns into a $100,000 position. You can also fund your account with USDC with no KYC needed, meaning you don't have to wait for ID approval. Just search the ticker, choose your position size, pick your payout multiplier, and you're ready to trade. Use the link in the description or scan the QR code on screen. You'll get a $20 deposit match by using code Findicate20 on Trench.io. By the way, Trench.io is also running a limited time offer, 40% lifetime affiliate commission. Check it out using my link in the description.
(1998). Citadel forces a choice on its investors: lock your money up for years or keep quarterly access and pay penalties to leave early. It is an outrageous demand. Hedge fund clients hold the leash, they do not wear it. A 29-year-old is telling the richest investors on earth that they may not have their own money back. And most of them accept.
This is the most underrated risk decision in hedge fund history. Locked capital isn't about control for its own sake. It changes what you can survive. If clients can't run, you're never a forced seller in a panic, which means in a panic, you're something far more dangerous, a buyer.
Weeks later, the timing pays out with a precision that looks scripted. Long-term capital management, a fund run by Nobel Prize winners, levered 25-1 across $125 billion, implodes.
Everything that long-term capital management owned, risky assets, was falling in price, and everything that it had sold short, sovereign risk-free debt, was going up in price, led to $4 billion in losses that brought it to the verge of collapse.
The collapse triggers a chain reaction. Funds everywhere face redemptions, and redemptions force fire sales. The entire industry is selling at any price. Citadel's capital is locked. Citadel does not have to sell anything.
Understand the mechanics. This is the play of Griffin's entire career. LTCM's positions weren't all wrong, many were good trades, held by dying owner. When the leverage forces the liquidation, price disconnects from value. You can buy $1 at 50 cents of price.
While Nobel laureates liquidate, the kid from Boca Raton goes shopping. Citadel finishes 1998 up 30%, and Wall Street quietly gives the firm a new name, the Grave Dancer.
Mr. Lay, I regret that you've chosen not to explain to this committee, to the American public, and to your former employees how you and others in senior management on the board of Enron apparently failed to completely fulfill your responsibilities.
December 2001. Enron, the largest energy trader on Earth, collapses in the biggest bankruptcy in American history. 20,000 employees. The world sees fraud, disgrace, ruin. Ken Griffin sees a talent auction.
The collapse of the deal between Enron and Dynegy has left Enron employees stunned, many of them wondering if they'll be getting their next paycheck.
Late today, the company announced that neither CEO Ken Lay or any other company representative will be here to answer questions.
Within days of the bankruptcy, Citadel's recruiters descend on Enron's disbanded trading floor. They interview hundreds. And note who Griffin hires, not the swaggering traders, the quantitative researchers, the meteorologists.
Hiring meteorologists sounds absurd until you understand energy markets. Natural gas is a weather bet. Demand lives and dies on winters and hurricanes. Enron scientists understood the physical world better than anyone in finance. Griffin bought that knowledge out of the wreckage for pennies, with no scandal attached.
Those hires seed a commodities operation built from the intellectual salvage of the most disgraced company in America. It will wait nearly 20 years, and then it will pay out billions in a single year.
This is the pattern investors should study. Griffin doesn't just buy distressed assets, he recruits distressed talent. People got mispriced in a panic, just like bonds. And unlike Bond, a great researcher compounds for decades. The Enron Raid may be Citadel's highest return trade.
But the next thing Griffin builds does not come from someone else's grave. It comes from his own oldest grudge. And it starts, once again, with a commission he refuses to pay. (2002). Citadel is now trading billions in options, and with every trade, broker-dealers take a cut, the same middleman's fee that enraged an 18-year-old with his first winning trade. Griffin's answer is not a complaint, it is a declaration of war. He builds his own market maker to do the job himself. He names it Citadel Securities.
Our deep heritage in software engineering and in predictive analytics would lead us to be a market maker of the future.
A market maker is the house at the casino table. It quotes a buy price and a sell price on thousands of securities all day and earns the tiny gap between them, the spread, pennies per trade, but do it millions of times a day, faster and more accurately than anyone, and pennies become an empire.
The timing is perfect. Options trading is abandoning the shouting floors for electronic screens, and electronic markets reward exactly what Citadel has been building since the dorm room: better models, faster machines.
We were moving from a world where you would call a broker, who would call for a broker, who would walk to a specialist pit who would do a trade, to an electronic world of straight-through processing trading. In other words, type an order on a computer, boom, it's executed in fractions of a second.
Almost nobody notices the side project. Within 2 decades, it will touch 1 out of every 4 stock trades in America, make Griffin the most hated man on the internet, and out-earn Goldman Sachs itself.
Founders, they talk about vision, but watch what bothers them instead. The home shopping network fee, the broker commission. Griffin's biggest business was built on a 20-year-old's frustration with middlemen. And when he couldn't get a fair price from the toll collectors, he didn't negotiate. He became the toll road.
By 2003, Forbes crowns him the youngest self-made member of the 400, worth $650 million at 34. The boy wonder has everything, and he is about to start circling the biggest carcasses of his career. September 2006. Amaranth Advisors, a $9 billion fund, is being destroyed in real time by one man's bet on the weather. Star trader Brian Hunter has built a colossal position on natural gas spreads, a wager that winter prices will spike again summer. The bet needs hurricanes, cold snaps, fear. Instead, the 2006 hurricane season comes in historically quiet.
Hunter wasn't betting on gas prices going up. He was betting on the gap between 2 delivery months. When the weather stayed calm, that gap collapsed, and his position was so enormous he couldn't exit without moving the market against himself. On the worst single day, Amaranth lost $560 million.
$6 billion evaporates in days, one of the fastest destructions of wealth in hedge fund history. Amaranth must sell its entire energy book immediately, or die holding it. And every buyer on Wall Street knows it. Citadel and JP Morgan take the whole portfolio at a savage discount, one of the largest commodity transactions ever executed. As the positions normalize, each reportedly clears on the order of $1 billion. Citadel absorbs Amaranth's surviving talent too.
Notice the machinery of the profit. Amaranth trades weren't all worthless. There were good and bad positions held by a corpse. A dying seller has no negotiating power. The discount Citadel extracted wasn't for the assets, it was for speed, size, and certainty, for being the only door out of the burning building.
The Enron scientists priced the book. The locked capital carried it, every piece of the fortress, working as designed. And 10 months later, the phone rings again. at 3:30 in the morning. July 2007. The first tremors of the credit crisis run through the system. Sowood Capital, a Boston fund seeded with $500 million of Harvard's own endowment, loses half of $3 billion in under a month. Sowood needs a buyer for its wounded portfolio tonight. Every firm on Wall Street knows it, and every firm has gone home. Citadel has not. Griffin's team works through the darkness, prices a book the market has declared unpriceable, and puts an offer on the table at 3:30 in the morning. The trade closes. As markets recover, Citadel books enormous profits on the corpse.
Pricing a distressed book overnight is brutally hard. Thousands of positions, frozen markets, no reliable quotes. You need models you trust more than the market's panic and capital that can't be called away. By 2007, Citadel was the only firm with both, plus the willingness to work while everyone slept.
And Citadel is not embarrassed by the timestamp.
Here's the tale about the culture. Citadel is so proud of the 3:30 a.m. deal that a detail sits in the firm's own official history. Most institutions hide the fact that they profit from overnight panic. Griffin advertises it because to him, it isn't something to hide, it's the entire business model, working exactly as designed.
3 carcasses in 5 years. Enron, Amaranth, Sowood. Each rescue makes Citadel richer, and each one teaches Griffin the same quiet, fatal lesson. Catastrophe is something that happens to other people. He is about to test that belief with the biggest purchase of his life. A drowning company's most poisonous assets, carried home onto his own balance sheet.
I said, down on the floor! Now just give your money to the tellers.
Getting robbed by your bank?
Lady, don't be a hero.
Come to E-Trade and earn 6 times the national average for savings and get easy free.
November 2007. E-Trade, the online broker, is bleeding to death. Its balance sheet is stuffed with mortgage securities rotting from the inside, and customers are fleeing on rumors of collapse. Griffin leads a $2.5 billion rescue, taking the toxic mortgage portfolio off E-Trade's hands at a drowning man's price. His public statement radiates reassurance. The deal will restore confidence, return the company to strength.
Read the statement closely. Griffin is learning a new language. The White Knight, the stabilizer of systems. He will need every word of it within 12 months when the drowning institution is his own. Markets have a long memory for this kind of irony.
But inside the triumph sits a detail almost nobody weighs properly. Those poisoned mortgage assets now live on Citadel's own balance sheet. A balance sheet running roughly $7 of exposure for every $1 of capital.
Leverage is a magnifier with no opinion. At 7-to-1, a 10% gain on your positions roughly doubles your equity, and a 10% loss nearly erases it. It's rocket fuel in calm markets. In a crisis, it hands control of your firm to your lenders. Citadel was borrowing like an investment bank without a bank's government safety net.
By the end of 2007, the portrait gleams. 39 years old, roughly $3 billion. One losing year in 17. Conqueror of Enron, Amaranth, Sowood, E-Trade. Publicly declaring Citadel will become the Goldman Sachs of the 21st century. The grave dancer has profited from every autopsy on Wall Street. But he has skipped the common cause of death. Intelligent people believing their models had domesticated risk. In 9 months, the panic will come for him. And this time, the panic will be right. July 2008. Quietly, Citadel posts a losing month, then another. Griffin runs his oldest play, buying beaten-down convertible bonds, the instrument of his boyhood genius. This time, the beaten down keeps getting beaten.
I would describe the 30 years as having had a few speed bumps, and then the moment in 2008 where the car basically went off the cliff.
For the first time in 18 years, the market is telling Ken Griffin his signature move is wrong. He responds the way lifelong winners respond. He does it bigger. Then, September 15th, Lehman Brothers dies. and the world Griffin priced ceases to exist.
The stock market suffered one of its worst days in years. The Dow Jones Industrial Average plunged more than 490 points. It is the sixth largest point drop ever.
And we do know that now that the fall of Lehman Brothers really froze the credit markets, of course, and really helped spark the worst financial crisis since the Great Depression.
The convertible bond market didn't fall. It effectively closed. No buyers at any price. Meanwhile, Citadel's brokers marked those unsellable positions down and demanded cash collateral against them. Margin calls. At 7-to-1 leverage, that's the death spiral. Losses trigger cash demands force sales deepen losses.
Every diversified strategy fails at once. Equities, credit, everything, correlations snap to one. The E-Trade mortgage book hemorrhages. October, down 22%. November, down 14 more. At the worst, Citadel is losing hundreds of millions of dollars per week.
Here's the brutal insight about these models. Diversification is a fair weather friend. Citadel held dozens of uncorrelated strategies, but underneath they share one hidden bet, that the financial system itself keeps functioning. In a systematic crisis, every position becomes the same position.
By November, the flagship funds are down 55%. $8 billion of client money gone. The firm named for the fortress that survives the burning city is now inside the fire. And Wall Street begins taking bets on the date of its death. There is a number that tells Wall Street who dies next, the price of insurance on a firm's debt. Credit default swaps.
Right. I mean, the most important part about the credit default swap is really referencing the underlying entity or the reference entity for the trade.
And in October 2008, the insurance on Citadel's bonds is trading at prices worse than Lehman's on the Friday before Lehman filed.
Remember the 2006 public bonds, underwritten by Lehman itself? That debt had a public price, updating hourly. Griffin had installed a heart monitor on his own firm and wired it to every trading floor on Earth. Now it broadcasts his odds of dying, and fear of failure causes failure. Lenders pull lines. The prophecy fulfills itself.
Rumors run in packs. Citadel will be tagged and bagged beside Bear Stearns, Fannie, Freddie, AIG. Investors demand $1.5 billion in withdrawals. Former employees will recall Griffin coming within inches of closing the firm. He will call it his low point, his word humiliating.
Wall Street's Whisper Network has a new target tonight following the collapse of Lehman and AIG. Rumors are swirling across trading desks about unprecedented liquidity pressure facing Ken Griffin's Citadel.
Then a trading partner at Citigroup, James Ferres, tells him the truth the rumor mill can't see. Citadel's actual cash position is fine. The firm is being killed by fiction. And the only antidote is the one thing a secretive hedge fund never does: go public. Griffin, constitutionally clandestine, stages an open conference call. He walks the market through Citadel's cash, line by line. Within days, the rumors break. The firm steadies. The fortress is saved by opening the gates and showing the granary.
This is one of the strangest survival stories in finance. Transparency as a weapon of last resort. When your debt trades publicly, silence gets priced as a guilt. Griffin understood that in a bank run. Information is liquidity. The conference call was worth more than any asset sale. It mispriced the fear itself.
The fiction is dead. The arithmetic is not. His clients still want their money back, $8 billion of it. And Ken Griffin is about to tell every last one of them, no. The rumors are broken, but the mathematics of death remain. Clients want out, and honoring their withdrawals means selling assets into a frozen market at fire sale prices. Every dollar returned destroys several more, so Griffin does the thing he will never be forgiven for and never apologize for. He invokes the gates, freezing investor withdrawals. Clients watching their money fall 55% are now legally forbidden from rescuing what remains. For 10 months,
The gates were in the contracts precisely because of 1994. Griffin had spent a decade acquiring the right to say no. And the cold logic held, meeting redemptions meant fire sales. Fire sales meant a death spiral, and the death spiral would incinerate the remaining capital of the very clients demanding exit. To save his investors' money, he imprisoned it.
The principals, Griffin included, put $500 million of their own money into the frozen funds. A signal, we are locked in the same cell. The industry's criticism is loud and lasting. Griffin absorbs it without blinking.
Judge it by the counterfactual. Funds that honor redemption in the late 2008 liquidated at the bottom and handed clients permanent losses. A fifth of all hedge funds died in that window. Citadel's clients hated the lock. The lock is also the only reason they got their money back. Both things are true.
In November, Griffin sits before Congress alongside Soros, Paulson, and Simons, 5 titans summoned to answer for the crisis.
Do you solemnly swear that the testimony you will give before the committee will be the truth, the whole truth, and nothing but the truth?
He speaks of the worst crisis since the 1930s, of the firm of 1,400 people he built. What the committee doesn't know is how close that firm stands to the edge, even as he speaks.
Today, our nation is working through the worst financial crisis since the 1930s. It is imperative that we as a nation continue to take actions to mitigate the impact of the credit crisis on our broader economy.
The gates hold. The firm survives. Now comes the strangest year of Ken Griffin's life, the resurrection and the funeral of his greatest dream. – 2009. The positions Griffin refused to fire sale come roaring back. The flagship funds return 62%, one of the great single-year recoveries ever recorded. The gates lift. The corpse walks.
But here's the cruel arithmetic of drawdowns. Down 55%, then up 62, still leaves you underwater. You need 120% gain to recover a 55% loss. Investors were still down roughly a quarter over 2 years. The math of losing is asymmetric, and it's the single most important lesson in this entire story.
The humiliation continues in rooms Griffin once owned. He flies his jet to Geneva to raise money and is interrogated about the wreck. Pictet, the great Swiss bank, questions him closely and declines. He compares the world's fascination with his losses to people who cannot look away from a car crash.
Life is full of disappointments, of speed bumps, of challenges.
And one dream dies quietly. With Lehman gone, Griffin tries to seize the vacuum and build Citadel, a full investment bank, the final piece of the Goldman fantasy. The talent won't stay. The clients won't come. By 2011, the effort is abandoned. The first sizable thing Ken Griffin ever built that simply fails.
Watch what the failure teaches him. Investment banking is a relationship business. Clients hire people, not machine. Griffin's edge was always systems over relationships. The bank died because it needed one thing he never built. To his credit, he cut it, took the loss, and never looked back.
In rare interviews after the fire, reporters noticed something stranger than the numbers. The man once described as humorless and stiff now cracks quips, and he has stopped saying the sentence that defined his decade of hubris. He no longer speaks of becoming the Goldman Sachs of the 21st century. The ambition hasn't died. It has gone underground, into the machine born of a grudge, quietly growing in the dark. But first, the fortress must be rebuilt. And this time, Griffin designs it so that no single human can ever sink it again, including himself. Out of the near death, a new architecture. No more balance sheet heavy conviction, no more illiquid bets held on faith. In its place, the pod model. Dozens of autonomous trading teams, each with its own book, its own tight risk limits, all watched by a central brain.
Think of it as a fund of mini hedge funds under one roof. Each pod hunts its own edge. The center sees every position. It can hedge the firm's total exposure or press a bet when many pods independently agree. Losing pods are cut in weeks. Winners get capital instantly. No single trader can ever again sink the fortress.
The revolving door, once a temperament, becomes doctrine. Talent is a position. mark to market daily. It is brutal. It is also the fastest growing format in the entire industry, as rivals scramble to copy it. Even the crisis's undertaker joins the payroll. Ben Bernanke, the Federal Reserve Chairman, who presided over the catastrophe that nearly killed Citadel, signs on as senior advisor in 2015.
From the right hand of President Obama to having the ear of one of the largest hedge funds on Wall Street, former Federal Reserve Chairman Ben Bernanke has signed on to be an advisor to Citadel Investment Group.
The private life is managed like a portfolio too. In 2014, Griffin files for divorce, timing the papers while his wife is mid-flight over the Atlantic. The war over the prenup, the bedpost, the million-a-month lifestyle plays out in headlines.
And there's another twist in one of the nation's biggest divorce settlements. The former wife of multi-billionaire hedge fund owner Ken Griffin is seeking $1 million a month in child support.
In 2015, the prenup holds. He redeploys into a record-setting real estate spree capped by a $238 million Manhattan penthouse. The fortress is rebuilt. The machine is humming. And out on the horizon, invisible to everyone, a dying video game retailer is waiting to make Ken Griffin more famous than any prophet ever could.
The U.S. is now the world's epicenter of the COVID-19 pandemic, and cases continue to multiply there.
Now, the breaking news from Wall Street in the wake of the coronavirus crisis. Stocks have stopped trading on Wall Street after a 7% drop.
March 2020. The world shuts down. And in an empty Four Seasons ballroom in Palm Beach, 50 Citadel Securities traders and their families move in, sealed off, luxurious, trading through the apocalypse. Griffin will call it perhaps the first bubble in America. The redesign passes its first true test. While hedge funds lose 7% in the crash, the flagship Wellington Fund finishes 2020 up 24.5%. The pods, the center book, the liquidity discipline, all of it working exactly as engineered. And the other engine catches fire. A lockdown world discovers day trading. Commission-free apps explode. And nearly every one of those millions of new orders flows through wholesalers, chief among them, Citadel Securities. Record revenue, $6.7 billion.
Here's what most people never understood. Commission-free was never free. Brokers like Robinhood sold their customers' orders to market makers. Payment for order flow. The market maker fills your trade from its own inventory and earns the spread millions of times a day. You saved $5 in commission. The wholesaler monetized your order. That's the machine.
Follow both engines to their logical end.
Step back and see what Griffin completed in 2020. The fund profits from volatility. The market maker profits from panic-driven trading volume. Fear itself. Ordinary people buying and selling in a crisis is now a revenue line.
Two engines, record output, $20 billion of personal net worth. Ken Griffin is the most powerful man in American finance, and the general public has never heard his name. That is about to change, in the worst possible way. January 2021. A dying video game retailer named GameStop has become the most shorted stock in America. At moments, more than 100% of its available shares are sold short. And on a Reddit forum called Wall Street Bets, millions of small traders have noticed.
A short seller borrows shares and sells them, betting the price falls. If it rises, losses are unlimited. The only escape is buying back. When shorts exceed available supply, buyers can corner them, push the price up, and shorts must buy at any price. Their buying pushes it higher. A short squeeze, a machine that feeds on its victims.
The squeeze detonates. GameStop runs from under $20 toward $483. Chief among the trapped, Melvin Capital, run by star stock picker Gabe Plotkin. Melvin loses 53% of its capital in a single month.
These protesters are sounding off on social media sites, calling for stock tips that will make the group rich while hurting hedge funds on the other side of the trade. But the Redditors figured out that if they collectively bought a bunch of GameStop, they could force a surge. The short sellers would have to buy back higher, creating what's known as a squeeze.
And on January 25th, Ken Griffin does what he has always done. Amaranth, Sowood, E-Trade. A brilliant manager is drowning, so Citadel buys the distress. $2 billion into Melvin, in exchange for a cut of its future revenues. 3 days later, the play that made Ken Griffin rich for 30 years finally makes him infamous. January 28, 2021. At the peak of the squeeze, Robinhood and other brokers abruptly restrict buying, not selling, buying, in GameStop.
The GameStop shares frenzy has seen a surge of stock purchases by small investors lead to losses in the billions for hedge fund pros.
The rally strangles, the price collapses, and millions of traders connect three dots sitting right next to each other.
Individual investors tried pushing up the price as some trading apps tried to limit the spending spree, and that caused even more controversy.
Citadel just bailed out the biggest short. Citadel Securities pays Robinhood hundreds of millions for its order flow, $142 million in a single quarter. And Robinhood just shut off the buy button. The internet writes the conclusion in a night. Griffin ordered the kill. Within a week, the name Citadel is raised in the White House briefing room. Senator Elizabeth Warren demands answers in a formal letter. Regulatory filings reveal Citadel's own fund even held a small short in GameStop. Every fact is legal and disclosed. Assembled on a screen by a furious crowd, they form the silhouette of a cartel.
Now, the sober record, Robinhood's clearinghouse demanded billions in emergency collateral as volatility exploded. Deposit requirements jumped roughly tenfold in a week, and the undercapitalized broker restricted buying to survive its own success. The investigations, the lawsuits, the SEC's own report all pointed at that plumbing. No evidence ever contradicted Griffin. Citadel even lost slightly on Melvin overall.
February 18th, the strangest hearing in financial history. Griffin testifies under oath, a face in a video grid beside Robinhood CEO Plotkin, and a YouTube trader called Roaring Kitty, who tells Congress, simply, that he likes the stock. 13 years ago, Griffin sat beside Soros and Simons. Now he answers to a man in a headband. Griffin refuses the penitent's script. Payment for order flow, he tells Congress, has driven retail trading costs to historic lows, a claim regulators substantially share, and one the crowd finds unforgivable.
With respect to payment for order flow, we simply play by the rules of the road. Payment for order flow has been expressly approved by the SEC. It is a customary practice within the industry. If they choose to change the rules of the road, we need to drive on the left side versus the right side. That's fine with us. I do believe that payment for order flow has been an important source of innovation in the industry.
He becomes the internet's Bond villain, mocked in millions of memes, and richer by the day, because the volatility the mob generates flows straight through his machines. "2022 is a bloodbath for everyone else. Stocks and bonds fall together. The S&P drops nearly 20%. The correlation nightmare of 1994 and 2008, back in force. It is the exact condition the rebuilt machine was designed for. Every seed planted across 30 years pays out at once. The commodities desk, born from Enron's meteorologists, blooded on Amaranth's book, delivers billions as war convulses energy markets. Fixed income harvests the fastest rate hiking cycle in 4 decades. Equity pods profit on both sides of a falling market. The flagship Wellington Fund returns 38%. Citadel's funds generate $16 billion in net gains, the largest single-year profit any hedge fund has ever produced, breaking John Paulson's legendary 2007 record.
Ken Griffin's hedge fund, Citadel, earned $16 billion in profit after fees in 2022. This is the biggest annual profit that a hedge fund manager has ever made. This new report shows Citadel is number 1 on the top 20 hedge fund managers list, beating out John Paulson's 2007 annual profit of $15 billion here.
Understand why this year specifically. Multi-strategy platforms don't need markets to rise. They need dispersion and volatility, prices moving hard in both directions. 2022 punished anyone holding assets and rewarded anyone trading them. Citadel had spent 14 years since 2008 converting itself from an asset holder into a pure trading machine. This was the exam it was built for.
January 2023. LCH Investments makes it official. Citadel passes Bridgewater as the most profitable hedge fund in the history of the industry. The goal written down in 2017, achieved on a 5-year schedule. Today, the tally exceeds $90 billion.
19.2% compounded annually for 35 years. Through LTCM, the dot-com burst, 2008, a pandemic, At Citadel's Miami headquarters, the ranking is literally engraved beside the elevators. Number 1 most profitable of all time.
And those elevators are no longer in Chicago. June 2022. Griffin ends a 3-decade marriage to Chicago, the city that made him, and moves Citadel and Citadel Securities to Miami. He does not join the city, he begins buying it. A $100 million compound. Star Island assembled parcel by parcel. A tower designed to dominate the skyline. 50 soccer fields donated across the county. Finance follows him south by the tens of thousands. Miami-Dade's population swells 11% in 3 years. Home prices double past $675,000. The ordinary city pays the housing bill for its coronation, while its new king donates hospital wings to soften the blow he himself is causing. The trophies turn national. In late 2021, he outbid 17,000 crypto strangers, a crowdfunded internet collective, to win a first printing of the United States Constitution at auction. $43 million. One phone bid. The internet mob versus Ken Griffin, one more time. Griffin wins, then lends it to a museum, free for the public.
About half an hour last night, the people who contributed $47 million in an attempt to buy a version of the U.S. Constitution. Today, it was revealed that the winning bidder was Chicago hedge fund billionaire Ken Griffin. Griffin says he plans to lend it to an art museum in Arkansas.
His politics run like his portfolio. Positions, not loyalties. $250 million to Republicans over a decade, yet never $1 to Donald Trump, whose tariffs he publicly torched as crony capitalism, as the death throes of a nation. He met with Trump about donating, kept the checkbook closed. For a man who buys everything, the refusal is the statement.
And I think that everything we spoke about that day is unfortunately still true today, which is that the administration's attempts to use tariffs comes at a dear price to the U.S. economy and comes at a dear price to the U.S. consumer, who will undoubtedly face higher prices in their day-to-day life because of these actions by the administration.
The empire's numbers detach from ordinary meaning. Citadel Securities, $12.2 billion in 2025 trading revenue. The whole enterprise, $39.6 billion, more than Goldman Sachs, the firm he once vowed to become. Behind JP Morgan alone, among every financial institution on earth. Personal fortune, roughly $51 billion. 57 years old. Decades of runway. No successor anyone believes in. And one question the record cannot answer. Weigh the ledger. He built, from a dorm room and a grandmother's trust, the most profitable investment firm ever assembled. He modernized the plumbing of markets, cutting trading costs for the very small investors who revile him. He survived a collapse that killed a fifth of his industry and paid every lender in full. And he perfected a machine that harvests, penny by penny, forever, the order flow of the amateurs. He monetized catastrophe, Enrons, Amaranths, Sowoods, Melvins, and calls it liquidity. He locked his clients in a burning building because he was right that it would save them, and never once apologized for the lock.
Both ledgers are true at once. That's what makes him hard to file. Every panic needs a buyer of last resort. And for 35 years, when nobody else would catch the falling knife, Griffin caught it for a price. The market genuinely needs what he does. It just doesn't have to like what he's become by doing it.
The firm has survived, losing 55% of its capital. It has never rehearsed losing him. For a man whose entire philosophy is the elimination of single points of failure, he has spent 35 years making himself the last one. The boy in Boca Raton was adjacent to wealth and could not bear the adjacency. The man in Miami owns the skyline, the scoreboard, the Constitution itself. Genius, predator, savior, villain. For 35 years, the answer has depended on which side of his trades you were standing on. The market, as Ken Griffin has always known better than anyone, will tell us, because somewhere tonight, the machine is still awake. A book is being priced in the dark. A phone is about to ring at 3:30 in the morning. If 35 years prove anything, it is this. On Wall Street, something is always about to die. And when it does, he will be standing at the grave, buying.